show me the money. That's what many investors are likely thinking when researching stocks. So it makes sense that one of the first places many of them start is a company's income statement. An income statement shows a company's revenue, expenses, and profits during the reporting period. Its purpose is to illustrate a company's profitability or how well it translates revenue into earnings after expenses. Investors can get a sense of how a business is trending by tracking items found in the income statements over time. Of course, they can be a little confusing if you don't know how to read them. So, let's walk through the 5 key sections, and we'll explain each piece with an example everyone can enjoy. A chocolate manufacturer. Let's dig in. Section number 1, revenue. This usually appears at the top of the statement, hence why it's called the top line. Revenue tracks how much money the company makes by selling its goods and services. It's simply the selling price of those goods or services multiplied by the number of sales booked. Sometimes, companies with multiple products will break out the revenue from each in a separate line. For example, let's say our chocolate maker earns money 2 ways: by selling chocolates in its storefronts and by selling tours of its chocolate factory. Together, they make up total revenue listed at the bottom of the section. Section number 2, expenses. Here's where the cost of doing business comes into play. The first item is typically cost of goods sold or cost of sales, depending on the type of business. It accounts for all the costs directly related to creating and selling products or services to generate revenue. That includes employee wages, supplies, raw materials, and the depreciation of any assets like machinery and equipment over time. For a chocolate maker, costs of goods sold would be items like labor costs, which include employee wages, supplies like baking sheets and kitchen utensils, raw materials like cocoa beans, sugar, and flour, and depreciation of equipment like mixers and ovens. Now, let's pause for a moment because we can learn a key piece of information here. When you subtract the cost of goods sold from total revenue, you get gross profit. It's a measure of how efficient a company is at generating revenue from its core business. This can then be converted into a percentage by dividing gross profit by total revenue. This yields the gross margin, a metric that makes it easier to compare a company's efficiency to that of its industry peers. Okay, let's dive back into our income statement. A company's indirect costs also fall under the expenses section. Items like marketing, advertising and promotional fees, research and development costs, and selling, general, and administrative expenses, or SG&A for short. That includes office supplies, facility rental, insurance, and travel expenses, among others. So, that trip to Switzerland our chocolate maker sales team took to pitch their product? Yep, their food and accommodation costs go here. The sum of all expenses in this section leaves us with total operating expenses. Now, let's take another breather for one more bit of information. When you subtract total operating expenses from total revenue, you're left with operating income. This tells investors how successful the company is at making money on a day-to-day basis. It's common for early-stage growth companies to have operating losses as they grow, so there isn't necessarily cause for alarm here. But it's generally a red flag when established businesses struggle to generate operating income. Now we move on to section number 3, other income and expenses. This is where any money gained or lost from one-off events or activities is logged. That includes interest earned and paid, investment returns or losses, proceeds from asset sales, and legal fees. For example, let's say our chocolate maker sold an old mixer in an auction. That sale isn't likely to be repeated next reporting period, so it would fall under the other section. Add or subtract all other income and expenses from operating income to get income before taxes. And that brings us to our 4th section, taxes. This is where any income taxes owing on a company's pre-tax income are tracked. It can include current taxes as well as future taxes, depending on the company's accounting practices. After we factor in income tax, we arrive at our final section, net income. This is what the company ultimately earns at the end of the day, its bottom line. When net income is divided by the number of shares issued by the company, we get earnings per share, or EPS. It represents how much money each share of the company would earn investors. Growing EPS over time tells investors that the business is becoming more profitable, while shrinking or unstable earnings tells them the company still has work to do. In our example, the chocolate maker's earnings are 50 cents per share. Of course, the income statement doesn't tell the whole story. The balance sheet and cash flow statement can help fill it in. So, make sure to check out our lessons on each one.